All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our weekly options recap. I know markets are closed here today, but I did want to jump on, cover a few different topics. We'll talk through some trades that we closed out here this week. We'll also take a look at what we're expecting for next week. We closed yesterday at all-time highs, and it has us shaping up for another active week and next week. If you have any questions throughout the session here today, feel free to type those in at any time. If you are watching the recording of the session, feel free to post a comment on YouTube or in Facebook, and we'll certainly get back with you right away. You can always contact me through email. Mike@netpicks.com is the email address. So let's jump in and let's talk about markets here, big picture. We knew we had the holiday shortened week here this week. Markets are closed today with Good Friday, but we did have the employment report that came out this morning around 8:30. The futures markets were still open, right? So if you look on the left-hand side of my screen where you see /YM, /ES, NQ, RTY, those are the index futures. YM is the Dow, ES is the S&P, NQ is the NASDAQ, and you can see all of those numbers are green. They all moved higher this morning. And that was in reaction to the news, the headline that hit with the employment number that came out was a pretty good report. Markets liked it, and the futures rallied higher. So I didn't do anything today. Obviously, you know, we can't trade options, can't trade stock here today. So I didn't do any trading this morning, but I was watching those futures markets closely because it can impact what we see early next week. All right. So look at Thursday's session. Another really strong session on a Thursday, synthetic Friday. And the reason I bring that up, we've seen how many rallies here over the past few months on Friday afternoon. We get these massive rallies going into the close. And yesterday afternoon, because it's synthetic Friday, markets are closed here today. So we did see that rally right up into the close. We closed right almost on the high tick of the session. That is a new all-time high on SPY, right at 400.67. That is our line in the sand going into next week. Looks like, at least from the futures move this morning, looks like we're going to get a higher open on Monday. What I am looking for early next week, I'm looking for a reversal. I'm not expecting the market to collapse. I'm not expecting a big crash. That's not what I'm talking about, but a healthy pullback we are due. Look what's happened over the past 6 trading days on SPY. A lot of green there, right? I mean, we tested the 50-period moving average, got down to around 380, 380 or so, and have since moved higher by $17. That's a big move on SPY. So we would love to see a pullback. Where would I be looking for as an area of support if we do get that pullback? The 8-period EMA is at 395.29. That's that pink line right there in the chart. I can zoom in and make it a little bit bigger, make it easier to see. That would be my first level that I would be looking at for support. If we break that level, we've got another little air pocket down to around 392-ish. Now, I know it seems like a long shot at this point because this market has just been super strong. Good news, bad news, doesn't matter. The market it's on a never-ending quest to rally higher. Now, much of that is due to what the Fed has done, pumping money into the system. And now we've got the Biden administration throwing money at the system. I mean, there's just trillions of dollars being thrown everywhere. And the market loves that, right? The more money in the system, the higher this market's going to go. So I would love to see a pullback. It would help work off some of these overbought conditions that we're seeing, after 5-6 days in a row on the upside. We need a pause. And we'll talk about how that plays into some of our trades that are on our radar for next week in just a moment. So on the upside, 400.67. If we continue to head higher, the next areas that we're looking at, 401, 401.50. The big round numbers and the big 0.50 levels would be areas that we'd want to look for resistance. We're at all-time highs. We're in uncharted territory, so there's no previous highs to look at. So we're going to look at those big round numbers up above us. The volume picture, 100 million shares, just under 100 million shares traded yesterday, which is actually a really good number. Going into a long holiday weekend, in many cases, you'll see volume contract. And you'll see slower trading going into that weekend. We didn't see that yesterday. It was very good volume. And it's been that way. The volume's been pretty darn good the last few weeks. Well in that 80 to 100 million share range that we like to see typically. If we continue to head higher next week, I would expect that volume number to start contracting. And that's why I want to see some selling to help keep that volume active. And not to mention, look at the ATR. The average true range indicator down at the bottom is now getting down towards that 5 level that we've been talking about in previous sessions. When the ATR, when the range in this market starts to contract, it doesn't give you as much movement to work with. I want to see that ATR active. I want to see this thing bounce off the 5 level and get back up towards 6. If we start to break that 5 level, get into that 4 or even that 3 range, you're really going to see much slower conditions, not as much activity. And for us as active traders, we want the opposite. We want good activity. So I'm going to be watching ATR very closely next week as well. A question that I got here yesterday afternoon was in reference to the VIX. The VIX takes a look at the volatility market-wide, specifically in the S&P 500. And in the upper left-hand corner, you can see the VIX got down to around 17.33 yesterday afternoon. This is the lowest VIX reading that we have seen in months. Essentially, going back to the beginning of the pandemic last year, last spring, we have not seen the VIX at these types of levels. What does that mean for markets, specifically for options traders? Let me take a look and show you a weekly chart of the VIX. That way we can see big picture what's happened the last few years. When we take a look at the pricing model of an option, when the volatility starts to get low, when the implied volatility that's being used to price the options gets low, the options are cheaper. The market's not expecting any type of big movement. They're not pricing in any type of fear. And when options get cheaper, it's a more friendly environment for buying options. We'll start to look for more of that here over the next couple of weeks. We've been trading a lot of credit spreads the last few months because volatility has been high. Now that volatility has contracted, we're going to start to shift our focus and take a look potentially at some additional long call and long put opportunities. But when you take a look at volatility specifically, look what's happened historically. When you start to see these spikes, if we start to go back a couple of years, when you start to take a look, when the volatility gets low, we'll see these short-term spikes. Okay, we'll see a short-term spike where it might last a couple days, couple weeks at a time. You can see them historically. Then we saw the pandemic hit last year and volatility exploded. The VIX got up above 80. It didn't last very long up at those lofty levels. We certainly saw it contract, but for the last 12 months, we have seen the VIX above 20. In fact, it's been between 20 and 40 now for months. Very unusual situation. That's a historic move in the VIX. There's no other time in history that we've seen the VIX this elevated for this long. Now that we've started to break lower, you can take a look here over the past 4 weeks. We have seen the VIX break through all of these support levels, all these moving averages, and close the week at 17.33. We're starting to get into this range now. You take a look historically, you can see that we're going to start to get back into that range. That number one is more typical, but it's also a range that it typically leads to at least some near-term areas of reversals. I'm not saying the VIX can't head lower from here, but as we start to get into that mid to lower teens, it's difficult for the VIX to head much lower than that. And especially in this environment, there's still a lot of economic uncertainty with the pandemic, with the lasting impact on some of the shutdowns and so forth. None of that's being priced in at this point. The market is just pricing in perfection. Right? It's just assuming the Fed is going to come to the rescue at any sign of weakness. So because of that, I am expecting over the next couple of weeks, I'm going to expect some of the fear to be priced back in. That would mean a bounce higher in the VIX and a move lower in equities. If that's the case, if I start to see the VIX expand, that would allow a long option to increase in value faster. That's a good thing. If we start to get some reversals in price, if equities start to move lower next week, I am more interested in long puts at that point, because a long put is going to benefit from a move to the downside. It's also going to benefit from volatility moving higher. We get a number of factors lining up in our favor. So that's what I'm going to be looking at here next week. Some potential opportunities for some long puts. And then if we do start to get a round of selling, I'm not expecting this market to stay down for any length of time, but it would be nice to get volume higher, get volatility higher, and that would potentially open up a new round of credit spreads. So all of that to say, ideally next week, we would love to see the VIX higher. I don't want to see the VIX get back down to that lower end of the range over the past couple of years when we saw the VIX briefly a couple of years ago get down to 10. We don't want to see that. That is not a fun environment to be in as an active trader. There's not much price action to work with, and we want the opposite. We want good action. So want to see the volatility expand here over the next week or two. Let's take a look at our overnight pop trades from this past week. A little bit different week because we do have the market closed today. We normally have 3 different expiration cycles to work with each week on SPY. We have options that expire Monday, Wednesday, and Friday. This week was a little bit different. We had Monday, Wednesday, and Thursday expiration cycles. We did not take a trade yesterday afternoon for Monday's expiration. I didn't for a couple of reasons. I had some questions on this. Normally, I like to put on a trade Friday afternoon, looking to close it out Monday morning. I didn't put one on yesterday because I knew we had the employment number out this morning before the market opened, while the futures were open, that is. If we start to see a big market reaction, there's not a thing I can do with an options trade to manage that position until Monday morning. I didn't want to be stuck in that position and have the market make a big move. It was also very unpredictable, knowing we're going into a long weekend, anything can happen, right? We're in 2021. The last 12 months have been unreal as far as headlines go. So I wasn't willing to take the risk and hold that risk over the long weekend. So we held off on putting a new position on for Monday. But this past week, we did close out of a couple of winning trades. We closed one out Monday morning, Wednesday, and then Thursday as well. The trade that we closed out yesterday morning, let's take a look at that one here. We came in Wednesday afternoon and we sold the 397, 395 put spread. So it meant I was selling the 397 put and I was buying the 395 put at the same time. And we talked about this in our midweek recap for those of you that joined us here on Wednesday. And we talked about that because we put the trade on expecting the market to head higher. And I walked through why that was. Going into a long holiday weekend, going into the end of the week, we know how strong the end of the week has been so far this year. A lot of market rallies going into the end of the week. We were expecting the market to stay higher. Well, unfortunately, I sent this trade out 3:30 p.m. Wednesday afternoon. We put the trade on, and during the last 10 minutes of the session, we saw a pretty decent sized market sell-off. And we were immediately underwater. At the time of Wednesday's video, we were talking about how that trade was underwater. We were down, I think, between $35 and $40 per spread. But I mentioned how a credit spread is nice because they recover much faster. All we needed was a move back above 397 here Thursday, and that's exactly what happened. We all know what the market did yesterday. We made new all-time highs. Well, we made money if the stock moved up, down, or sideways, as long as it stayed above 397. We also made money from the time decay being so extreme. That close to expiration, the time decay is very, very extreme. And we made money from volatility decreasing. So yesterday morning, I sent out a closing alert, and I know we've got some members in here today. So a couple of you asked, when I send out the alert, and yesterday's alerts, let me actually get the exact alert up on my phone. Bear with me a second while I pull it up. So when I sent out the closing trade, I'm always going to give the minimum or maximum price that we're looking to get filled at. Right. So the question became, if I send out a range of pricing, how do I know when to get out? Do I get out immediately? Do I, hold it and wait for a better price? Yesterday, the alert said we wanted to get filled at 30 cents or lower. Now, where did that 30-cent number come from? We wanted to get filled at 30 cents because that would give us 50% of our max profit. We collected 60 cents on the trade. My target range was between 15 and 30 cents. That was the range of pricing that I was looking to get filled at yesterday. Some people got that alert, closed it out immediately, right on 30 cents, a few cents better in some cases, and they just booked the profit and moved on. I'm perfectly fine with that. There are times where I don't mind holding later into the morning, looking for a target or looking for a closing price closer to the 75% target level. That's why I ended up doing yesterday. I ended up holding the trade longer. A lot of that was due to the fact that we knew we were going into the weekend. Markets have just been super strong going into weekend. So I ended up holding longer. I don't always do that. You can see on these trades, some of these recent trades, I ended up getting out much earlier. If I don't feel comfortable holding it later into the session, there are times when my schedule just doesn't allow me to do it. If I know I have a very busy day working with students, or if I'm traveling, I'm going to close out of that trade as quickly as possible, even if it means giving up some profit potential. Yesterday, I knew I was in the office all day. I had a very bullish opinion on the market yesterday, so I ended up holding the trade longer, and I ended up getting out at the full 75% of max profit level. I got it at 15 cents. It gave us $45 of profit per spread. That's a 32% return on our capital in and out overnight. Open it with about 30 minutes to go in the session Wednesday, closed it out mid to late morning on Thursday. Okay, so really great trade there. Again, couple of winning trades. We talked about it a few weeks ago where we ended up having our first losing trade in the last 20 trades. It was a 10% loser, and we followed it up with 4 winners in a row. So the system continues to do exactly what we're looking for it to do. It's providing a consistent source of income. It's providing a very forgiving approach, trades that have 5 ways of making money, and we're in and out in less than 24 hours. This is one of my favorite trades right now. Now, when you take a look at these results, $40 a profit, $33, $38 a profit. Doesn't look all that impressive. Remember, that's only taking one spread on each trade. These returns are going to be in the 20, 30, 40% return range overnight. That's huge, right? We can take these trades with multiple spreads. All of these trades that we've taken since the service was released, on average, they're requiring $149 per spread. Very reasonable regardless of your account size. You can take these trades with 10 spreads and still have less than $1,500 of risk in many cases. That trade yesterday, taking it with 10 spreads, you've got $450 of profit on that trade, tying up $1,400 of capital. Okay, now all of a sudden that sounds a little bit more impressive, right? You start to build that account size over time. We're managing the risk over time, keeping that risk small. These trades will add up in a hurry. When you're taking multiple overnight pop trades each week, it adds up to a very reliable source of income and a nice boost to some of your other trading if you're taking more longer term trades. So really nice trade there. Our next opportunity for an overnight pop trade would come Tuesday afternoon for a Wednesday expiration. So we'll hit the ground running here next week, see if we can get a few more winners on, get that winning streak built back up again for us. Let's go ahead and take a look at a couple of new trades setting up for us next week. Let's talk about SPY. We've talked about it on the daily chart. Now let's go to the 130-minute chart. This is a time frame that I love to use for my entry and exit points. I like to use the 130-minute. I love to use the 195-minute. Those are my 2 preferred time frames. Right? The 130-minute, we've seen a very impressive move higher, no doubt about it. I mean, the last week, it's been off to the races. We still have not hit any type of significant overbought extreme long term. Would I be interested in an overnight pop trade next week on this one? Sure. But I still ideally would love to see one more push higher, and we may get it. Looking at the futures here, looks like there are going to be green Monday morning, Sunday night into Monday morning. If we get one more push to the upside, we could potentially hit an overbought condition. Now, how would I quantify that? Down at the bottom, we have our pulse indicator. We've talked about this in previous sessions. Right now, it's plotting red. For me to have an overbought condition, I need either yellow or green bars like we have seen over the past couple of weeks. For those bars to plot yellow, I need price to be between a 1 and a 2 standard deviation move on the upside. Right now, as of the close yesterday afternoon, the pulse indicator is at 0.92. I need it at 1.00 or above. That could potentially happen first thing Monday morning if we get any type of a move higher. So if that happens, that has me potentially interested in a neutral to bearish position, potentially selling a call spread. If I'm going to get a long put option opportunity next week, I talked about that a few moments ago. I'm definitely going to be looking at some long options next week because the volatility has contracted so much. In order for me to get a short setup on SPY, I need price action to reverse. I need to see our trend strength histogram down at the bottom. Right now it's sitting at 1.69. I need that below 0. Right? That's going to take some work. It can't just be an overnight gap. It can't just be an hour of selling. I need this thing to flip below the 0 line. So we're going to need to see some follow through before I'm interested in a long put. I also want to see price break our 8-period exponential moving average. That's that red and blue line up top. We're pretty extended from it currently. So again, we're not going to have an immediate long put set up first thing Monday morning. It's going to take some work. I'm going to need to see price action reverse, which fully expecting first half of the week next week. I'd be very, very surprised if we just got through the entire week next week without any type of selling pressure. So definitely on my radar, but it's going to take some patience to start the week. The NASDAQ ETF, QQQ, still sticking with the 130-minute chart. This one a little bit different. All right, so the NASDAQ has been very active over the past week, and this one on the 130-minute chart has already given us a yellow reading on the pulse histogram. This one has me interested in selling an out-of-the-money call spread going into next week. Right? Volatility has contracted. It certainly has. Ideally, I would like the volatility to be higher when selling the spread, but I don't need it to be. Okay, I can still sell a spread here. I can still use a credit spread. I'm probably not going to have the benefit of volatility helping me. Okay, because it's already contracted so much. If volatility expands, it wouldn't help me, not with a credit spread. So for a long put options, very similar to SPY, I need to see our trend strength histogram fall below the 0 line. I need to see price action break the 8 EMA, which is that blue line on the downside. So have some work cut out for us for long puts, but a short call spread next week, very much on my radar. Okay. A trade that we put on towards the end of the week with our NASDAQ service, let's take a look at Adobe. Symbol ADBE. You can see here again, just like the NASDAQ, very similar chart pattern to the NASDAQ. In fact, we have seen a really nice push to the upside, enough to give us an overbought condition. Price is between a 1 and a 2 standard deviation move on the upside. That's why these bars are plotting yellow. And as of the close yesterday, the pulse indicator got to 1.95. If that gets above 2, these pulse bars are going to start to plot green, indicating even a stronger overbought condition. So I went ahead, and those of you that are part of the NASDAQ service, you saw this alert come through in real time. Let's go ahead and pull it up. We wanted to put on a neutral to bearish position that would benefit from price action either consolidating or reversing to the downside. Look at what's happened in other cases previously when we start to get those yellow bars on the pulse. If we go back to February, we had an overbought condition. We had yellow bars on the pulse. Look what happened. Okay, we saw price action make a high and then immediately reverse lower. We saw oversold conditions back early March. We saw yellow bars, even a couple of green bars on the downside. What happened? Price action started to find some support. It wasn't immediately, right? We didn't get an immediate reversal once those yellow bars started to plot. It took a couple of days. What happened? Price action reversed and steadily moved to the upside over the past couple of weeks. Now we've got another series of yellow bars on the upside. It doesn't mean price can't move higher from here. It just means it's not statistically probable. Odds favor a period of consolidation or a reversal to the downside. So what we did, let's go back over to Thinkorswim. And we'll switch the symbol to ADBE. And let me grab my other screen here so I can get the details of the trade. We went out to the May monthly options. Over the past few weeks, I have been trading a lot of the April monthly options. Those of you that have joined us for these sessions, you have seen that. We've been trading a lot of these Aprils. The problem with those is they are now down to 14 days left to expiration. A little bit too aggressive to initiate new trades with that short of a cycle. I am starting to transition out into the May monthly options in many cases. If you have positions on in April, I don't have a problem holding those. I'm just not going to open up new positions in April. I'm going to start to move a little bit farther out in time. In most cases, I like to be in that 20 to 60 day window, 20 to 60 days left to expiration. I went out to the monthlies because I want to take advantage of the better liquidity, the bigger volume that we have, the bigger volume and open interest that we have out in May. Could you trade some of these weeklies in here? We have weekly options of 21, 28, 35, 42 days left. You could. Just be cautious. When you open some of those up, you'll see Adobe, for example, has volume. It's just not anything overly impressive. What you want to see here, ideally, open interest is more important to me than volume. Ideally, I want to see good numbers on both, but open interest indicates to me that that option has been active over a period of days or a period of weeks. If you see good volume, it can be a little bit misleading because that good volume might just be in reaction to a news event in one session, or it could just be one big institutional trade that went through. So ideally, I want to see good numbers on both, but open interest is more important to me. And these numbers, I mean, you've got 60, 70, 40 contracts of open interest. There's activity there. It's just not overwhelming. If we go out into May, a little bit better here, right? Because now instead of having 20, 30, 40, 50 contracts of open interest, now we've got a few hundred contracts, in some cases over 1,000 contracts of open interest. That's going to make it easier for me to get filled on a trade. And I'm probably going to get a better price as well. So what we did in the May monthlies, we put this trade on yesterday. We came in and we sold the 500, 505 call spread. I went to the 500 call. I right-clicked on it. I went to sell, and I selected vertical. That pops up an order down at the bottom where I am selling the 500 call and buying the 505 call at the same time. We're trading two options at the same time. I'm placing this order as a spread. I've had some questions this past week. Newer options traders, newer traders to the whole idea of using a vertical spread. You want to place and manage these trades as spreads instead of just individual options. If I were to place this trade, instead of doing it all as one trade, let's say I came in and I created an order to sell the 500 call, and then I created a separate order to buy the 505 call. The problem with that approach is if you get filled on one side or not the other. Let's say you fill on the 505 call, but not the 500 call. If that's the case, you're left with a completely different position. I want to place this trade as one trade. I want to place it as a vertical spread. If I can't get filled as a spread, I don't want the trade. Same goes for closing out of a position. I don't like to leg out of positions. Some people will say, hey, I put it on as a spread, but I'm going to close it out. Just closing out of one individual option at a time. I don't like to do that. I like to open them as spreads, close them out as spreads as well. So this setup that we sent out yesterday, let me grab my alerts. You would think I'd be able to remember the alert because it was less than 24 hours ago, but my brain is fried at this point. I'm in weekend mode. So the alert yesterday stated we wanted to get filled at $1.30 or higher. If I come in and load up this spread, I want to make sure I can get filled at $1.30 at a minimum. If I can't get $1.30 and I start to adjust the order down to $1, I don't like that because now if I only get filled at $1, I'm risking 4 to make 1. If I get filled at $1.30 or above, I'm going to have a better risk to reward ratio. Take a look at this this trade from yesterday afternoon. The price of the spread, the mid price, closed at $1.67. We got filled on this trade at $1.63 yesterday. So let me adjust the price to $1.63. Instead of risking 4 to make 1, I'm risking 2 to make 1. Right? I'm risking $337 to make $163. I can make that work. Okay, that ratio will work. Risking 4, 5, 6 to make 1, it's more difficult. It's definitely more difficult to make work over time. If I can keep that ratio initially at risk 2, risk 3 to make 1, we can certainly make a good return over time across all our trades. We have 5 ways of making money on this position. We make money if the stock moves up, down, or sideways. It doesn't matter to us as long as price stays below 500. We can actually take it one step further. My actual break-even point's at 501.63. because we've got to take into account the $1.63 that we collected to put the trade on. So directionally, I make money the fastest if the stock moves lower. That would be the perfect scenario. But if it doesn't, if we just chop sideways or if we just kind of drift higher or lower, I can still make money from that as long as price stays below 501.63. We make money from the time decay adding up and from volatility decreasing. So we've got 5 ways of making money on this position. The best news here too, other than the fact that we have 5 ways of making money on the position, if I take a look at just coming in and buying a long put, I mentioned the whole basis for this trade is because markets got overextended. They're overbought in the near term. If I come in and buy a long put option, let's say I buy an in-the-money put. Let's go to the 490 put. You're talking about over $2,200 to buy an individual put. That's tying up a ton of capital. For a lot of retail traders, it's not doable. With the spread down here, I'm tying up $337 of capital. Now it's much more reasonable, and it's a fully risk-defined trade. If I am dead wrong, the most I'm going to lose is $337, but the only way I lose the entire investment is if I hold all the way to up to expiration for the next 49 days. If I close out of this trade anytime beforehand, if the trade's moving against me, I can always close it out and take a partial loss. All right? So it's a much easier way to manage our risk. Much more forgiving type of trade as well. So this is the position from yesterday afternoon on Adobe. And I had some questions. You know, I get it, guys. I mean, this market has been so rock solid. It's been impressive. Right? I mean, it just feels like the market wants to head higher indefinitely. What you want to keep in mind, long term, we want a mix of bullish and bearish positions. We've been taking bullish trades off now for quite some time. I mean, in the last couple of weeks, we've closed out of a number of positions. We closed out of a couple of additional bullish trades here last week. So I want to make sure that I'm positioned to benefit from whatever the market throws our way. Are we certainly starting to lean a little bit more bearish in the near term? Yes, just given market conditions being so overbought. So with a credit spread, a lot of times people, they want to look for perfection. And they're looking for all of those different factors to line up in our favor. They want the perfect trade that has no opportunity or no risk of losing money, right? There's no such thing. So is the market overbought? Yes. Is the market making new all-time highs? Yes. But that's not going to prevent me from taking neutral to bearish positions, because ultimately no one knows what's going to happen next. And there's going to be times when we will get those immediate reversals. And I want to be positioned for that. I want to have some of those trades on. If we take a look at all of our trades here, going back really to the beginning of this year, I mean, we're working on over 30 winning trades in a row. If we take a look at this column, this middle column, it's been a mix of bullish and bearish positions. The ideal scenario for an options trader is for back and forth price action to occur. That's ideal. And we've had that the last few months. This market's made great movement back and forth. What I don't want to have happen is going into that dreaded one-way directional move higher. I want the back and forth movement to continue. I do think it will. Not saying we're going to be able to sustain this pace with all of these winning trades in a row, but we don't need it to. We can't maintain a 90% win rate all year long. It's not realistic. We're going to have losing trades along the way. We're going to do our best to minimize those losing trades, but we want to make sure that we mix our portfolio as much as we possibly can. I've got some bullish and bearish trades on right now. In all likelihood, some of those trades are going to win, some of those trades are going to lose. That's just part of the game. So managing that risk scene as diversified as we possibly can. You know, we talked about that earlier in the week too, for those of you that joined us on Wednesday. You know, I've talked to so many people here lately that are trading off of what they think the market should do. Okay. Now, the problem with that is if you use the wrong strategy, let's just say you think the market's overbought, so you come in and load up your portfolio with long puts. What if the market doesn't give us a big pullback? You're in trouble and you're facing a large drawdown, right? Well, if you're, what if you're 100% bullish here? You're all in on long puts. You're all in on selling put spreads. And then the market pulls back. You're facing a large drawdown. So the bottom line is mix up your trades, mix up your trade types. If you want to lean bearish here, that's fine. But until price action confirms, until we start to see some of those support levels broken that we talked about earlier, if you want to lean bearish, use the credit spreads. They're going to be much more forgiving. You're going to be able to better control your risk. So that's why I continue to preach, and I'm going to continue to do it going forward, because so many people are just continuing to fight it. If you're trading long calls and long puts, add in the vertical spreads as soon as you can. It's going to be a much better way to control your risk. It's going to give you way more flexibility over time. All right. So we want to try to block out as much of that outside noise as possible. There's people out there calling for a crash. There's people talking about markets, you know, making another 20, 30% move higher this year. I've seen it both ways here the last couple of days. Bottom line is no one knows what's happening next. So just manage that risk, keep the risk small, focus in on creating that consistent source of income, regardless of what the market is throwing our way. Is this session live? Yes, we are here live. Here. I know markets are closed, so it's a kind of an unusual time to do a live webinar. But yes, we are doing a recap webinar here, just to kind of walk through some of our trades from this past week, and then also walk you through some things that we're looking at for next week as well. All right. So if you have any questions on anything that I have covered here today, or anything that I've not covered, you have markets that you want me to take a look at, go ahead and type those questions in now. Can I switch to Bitcoin? I do not trade Bitcoin personally. So I'm not going to be the best resource to give you an opinion on Bitcoin. Here's why I don't trade it personally. I don't like to trade markets that limit you to one directional move. Okay. Meaning you can only play Bitcoin from the bullish side. Okay? You can't short Bitcoin. It's very difficult to benefit from the market moving lower. I don't like that scenario. It's not my style. I want to have the flexibility. I want to trade markets that allow me to make money if the market's moving higher or lower. That bottom line. I'm not saying Bitcoin is bad. I'm not saying you shouldn't be trading it. It just doesn't fit me and what I do as a trader. So I just don't try. I mean, I glance at it. I look at, I look at it periodically, but I'm not active in that market myself. So not going to be the best resource there. I focus in on trading options on the most liquid stocks and ETFs. All right, guys. So I'm going to start to wrap it up here for the week. Enjoy the rest of your long holiday weekend. we'll be back here next week. I'll be back on Wednesday for our midweek update at that point. We'll take a look at where we stand market-wide. We'll take a look at some of the trades that we referenced here today, see what the market brings us next week. So again, enjoy the weekend, everybody, and I will be back with you guys here midweek next week.